What makes a stock price move? Well, when a company is first listed on the stock exchange, they need to divide the company ownership into different parts, and these parts are called shares. When a company is first listed on the stock exchange through the initial public offering, which is also known as the IPO, they only issue a fixed number of shares out into the open market. The company decides how many shares they want to issue, and in this example, company XYZ decides to issue 7 shares. Now, these shares are called outstanding shares. It represents the total amount of shares that company has issued to the public to buy and sell. Now, in real life, this amount can range from 100,000 to 10 billion shares. But seeing that I don't have enough room on my screen, we'll just stick with 7. So company XYZ has its 7 shares that they would like to sell to the public in order for company XYZ to raise money for certain projects to help them grow. They do this at the initial public offering, which is the very first day the public can buy shares of that company. So they release the number of shares into the public, and the public buys the shares, and people like you and me are able to buy these shares. And these shares are the only amount of shares that can be traded. There's only 7 of them. So this is the supply of company XYZ. But it's going to be up to the public to determine the demand for the shares of company XYZ. Now, when a company becomes a publicly traded company, meaning they are listed on the stock exchange, they have to disclose all financial information related to that company, such as how much money they are making, how much were their expenses, what their earnings per share is, and how many sales have they done. And they release this information every quarter. All this is required to disclose to the public so that the public, like you and me, can digest this information and make an informed decision on whether this particular company will rise or fall in value in the future. And this is all speculative to the individual looking at this information. When one investor sees opportunity, another investor doesn't. So let's say John over here owns a share and he decides, you know what, I don't like company XYZ. I don't think it's a good investment anymore. I want to sell my share. But then you have Lisa that may say, hey, I like company XYZ. I think they are great. I want to buy more. So John sells his share to Lisa. Same with Susan. She might say, hey, I like company XYZ. I want to buy some more shares. But then you might have Maria say, I want to sell my share of XYZ because I bought at a good price, I made some money, and I think there's a better company out there that I can use my profits to invest in. So Susan buys Maria's share. Now let's say you have Aubriana and Jeremy come into the picture. And they both say, hey, I really like company XYZ. I want a share. Who's selling shares? Because I want one. So then you may have Susan say, hey, I changed my mind. I don't want my shares anymore. I want to sell them. So she sells both of her shares to Aubriana and Jeremy. So hopefully what you can see is happening here is we are all just exchanging shares with each other from the same initial pool of 7 shares that company XYZ has released when it was first listed on the stock exchange. Now let's take this a step further and add prices to each of these shares. And this is how the stock price moves. Let's say that everyone's shares are worth $10. But then Tim comes along and he says, hey, I like company XYZ. I believe in them. I think they're going to do well. I want to buy some shares. But in order for Tim to buy shares, he has to buy them from someone who is selling. So let's say Maria wants to sell her shares, but only wants to sell them at $10.05. Maybe she bought it at $10 and she says, hey, I bought my share at $10. I don't think XYZ is going to go up any higher. I just want to make a quick 5-cent profit, so I want to sell my share at $10.05. And Tim says, hey, I'm glad to buy that share at $10.05 because I believe company XYZ will be worth much more in the future where I can sell and make a huge profit. Now, since that last transaction was at $10.05, theoretically, everyone else's share is now worth $10.05 because that was the last price that someone was willing to pay, and therefore that's what the share is worth. Now let's go the other direction. Let's say Alvin comes along and he says, hey, I like company XYZ, but I think it's priced way too high. I'm not going to pay $10.05, but I will be a buyer if someone sells me shares at $9.90. And Lisa just saw on the news that company XYZ is getting sued. Lisa says, hey, that's bad news. This company is going to drop in value. I want to sell my share before that happens. I want to get out immediately. So she sells her share to Alvin for $9.90. And because of that one transaction, everyone's share is now worth $9.90. Now, in a real-world scenario, these transactions are happening at the speed of light, with thousands of shares exchanging hands every second. So the price is always changing, but it's all based on what people think the future value of that company will be. And just like from our example, everyone has different opinions and wants to buy or sell shares at different prices. So in order for the stock price to go up, there has to be a reason for the majority of people to believe the price will be higher in the future. And in order for the price to go down, there has to be a reason for the majority of the people to believe the price will be lower in the future. It's all supply versus demand. The supply is going to be based on how many people want to give up their shares. And the demand is going to be based on how many people want to own shares. So that's the basics of how stock prices move up and down. I hope you all learned something. Thank you so much for watching.